Alright guys, welcome back to the channel. I wanted to show you guys how you can optimize the weights on your portfolios, more specifically your M1 portfolio. What I've seen is that you guys group stocks and ETFs into sectors or industries, and then within each of those bins you guys assign weights to those stocks. And then on a broader scale you guys group all the sectors and industries together as a whole. And in this video, I'll show you guys how you can optimize the weights to each sector and industry. Alright, so we'll start off by naming the tickers in our portfolio. Alright, so I just put some random tickers and then I'm going to group these into sectors or slices. So I'll create a new environment called E so that when I download the data, my global environment doesn't have a bunch of variables in here. Everything will be stored in this new environment. So we'll use get symbols. We're going to send it to the new environment. And I'm going to start my data from 1990. So I'll download the data now. Alright, so next I'm going to convert each object in my new environment to a monthly series, because we usually rebalance monthly instead of daily, and we eliminate stock noise. So we use to monthly. So now each object or stock should be in a monthly form. Now I'm going to store all the adjusted closes into this new variable called port by running do call merge l apply, and then our function will be AD for adjusted. I'm going to rename column names by dropping adjusted. And then I'll calculate the monthly returns by using ROC. If there's any NAs in my portfolio, I'm going to replace those with 0. So take a look at our portfolio. Everything should be monthly. So it looks like for these ETFs, they didn't exist back in 1990. That's fine. So everything looks okay. Alright, so now I'm going to group stocks into sectors. That's usually how you guys keep these slices in your M1 portfolio. So for bonds, so we'll set the tickers here for my bond slice, which is BCLT, BNDX, VTIP, and BSV. So that makes up my bond slice. The next thing I want to do is create weights. Depending on how you have this slice, you will enter your weights in this section by running reclass core data in bonds. We're going to vector multiply that by the weights. So say if you have these equally weighted, you will place your weights here corresponding to each stock or ETF that belongs into that slice. Another way you could run equal weights is to run rep 1 divided by the number of columns in bonds by the number of columns in bonds. And you will get a nice vector of equally weighted weights. So for each of these slices, I'm just going to make these equally weighted. But if you don't have them equally weighted, then you would just enter your weights in here. All right, so if we take a look at our returns, we have nothing started until 2007. So what I've done is that I've assigned weights to my bond slice, grouped them together, and made one XTS object for this slice. And then you would do this for all the slices in your portfolio. So this will be my communications. So we'll run port, and then we'll place the tickers belonging to this slice. And then again, just assign the weights that belong to that slice for each sticker or ETF. I'm going to repeat this process for each slice that I have in my portfolio. So I'll group them into slices, and then we'll continue from there. All right, guys, so I basically grouped all the tickers into sectors. So these are for bonds, communications, consumer cyclical, consumer defense. I have a dividend generating slice, financials, health, industrials, real estate, tech, and utilities. Next, I will merge all the sectors together, and we'll take a look at their performance. All right, so we'll take a look at the performance for each sector. All right, so by far the best performing sector is probably tech. The sector that generated the least returns was bonds. What I want to do now is assign weights to each sector that will maximize my return, and I want to do that in a way that will hopefully beat the S&P 500. So we'll start off by assigning weights to these. And then here you will place your weights that you have in your M1 finance portfolio, but remember that they have to be in this particular order. So say for real estate, I have allocated 25%. For utilities, I have assigned 15%, and so on and so forth. So here I'll just fill these in. And just to double check, I'm going to sum these weights, and they hopefully add up to 1, which it does. All right, so this will be our current portfolio in M1 Finance. And for comparison purposes, I want to compare it with the S&P 500. If there's any NAs, I'll replace those with 0. I'm going to change the column names to SPY. All right, so now we'll compare them by plotting them. I'm going to merge my portfolio with SPY. Geometric false. We'll take a look. So if we were to have maintained this portfolio since 1990. We clearly outperformed the S&P 500. This is typically what we want to see in a portfolio. But now, like I said, I want to assign weights to each sector that will maximize our return. So we'll start by building a function to optimize. And what I'm passing is the weights. And I'll get to that in a bit. So this will represent the weights for our first slice or sector, our second, and so on and so forth. Next, I'll do a weight penalty so that these weights sum to 1. So we'll do 100 multiplied by 1 minus the sum of n, which is our weights, to the power of 2. So that the sum of our weights is exactly 1. And then here I'll return called sums of our portfolio plus our weight penalty. And I set this to negative because in our optimizer it'll seek to minimize. I'm going to add a brief function so that our weights are rounded to 2 decimal places, similar to M1 Finance. So we'll run these 2 functions, and then we're going to use our optimizer from DE optim. And then the function that we want to apply this to is our function to optim that we just created here. Our lower boundaries is that I want to allocate at least 5% to each slice. So we're going to represent that by making a vector of minimum weights, which is 5% by the number of columns in all. And then our upper limits are going to be our weights to the upside. So I don't want to allocate more than 25% to each slice. And then our control group will be list, and the maximum iterations is 1000. We're also going to pass our function here so that the weights round 2 decimal places. So I'll run our optimizer. So it's going to stop when it hits 1000, and these are the portfolio returns and then the assigned weights. Alright, so here are our best combination of weights, which yielded approximately 424%, which seems a little bit higher than the current weighings of our portfolio, but we'll compare it right now. So here we use our $optim. So these are our best weights. If we take a look at our slices or sectors, it looks like it's industry heavy and I want to say tech heavy. I want to double check that the weighings equal to 1 or approximately 1. So the sum of the weights is 1.02, which is 2% over. So it's not exact, but it's a very good approximation of the weights. So I'm going to apply these weights to our portfolio and then compare the returns. So now I'm going to use this. Alright, so now I'm going to merge our current portfolio, our benchmark, and then our optimized weights that yield the best return. Alright, so now you see that by using the optimized weights, we get a much higher return, and the drawdowns kind of remain on par with the current weightings of our portfolio, which is good. Typically, you want to see less of the drawdowns. Alright, so depending on your risk appetite, I will create another function to optimize. So now my objective will be to minimize beta. So we'll use performance analytics function called capm beta. We'll pass in our portfolio. Our benchmark will be the S&P 500. And for simplicity, I'll use the risk-free rate as 0. So this will be our function that we want to minimize so that the sum of beta is close to 0 as possible. So we'll run that, copy my optimizer, change the function, and we'll go ahead and run this. So here is our betas. As you can see, they are decreasing. We want to get as close to 0 as possible. Alright guys, so it finished running, and it looks like the best combination yielded a beta of 0.46. So again, we'll extract the weights here. It's heavily weighted in real estate, bonds, in our dividend class, and a bit towards industrials. We'll check the sum of the weights, which is equal to 1, and then we'll apply the weights. We'll change the column name to minimum beta, and then we'll chart it. Alright, so it looks like our minimum beta is underperforming the benchmark slightly, but we see that the drawdowns are far less than the SPY. So essentially, we get the same results as the benchmark with a lot less volatility, which is an option if you're more risk averse. And then lastly, what I want to return is an equally weighted portfolio, so we can compare all the portfolios together. So we'll apply core data, all, multiplied equally, which is approximately 9% for each slice or sector. Alright, so you see that our equal weight outperforms our current portfolio, and it also outperforms the benchmark and the minimum beta portfolio. So there's another option you can use. So it looks like the best portfolio to invest in is our best return portfolio and the equally weighted portfolio. For your information, I wouldn't really invest in the best return portfolio because since it's heavily weighted in tech, almost 25%, say that sector tanks, then it would severely impact this portfolio. Just because in this time period technology has outperformed other sectors doesn't really mean it'll continue to outperform the rest of the market. That's why a more conservative approach, such as the equally weighted or the minimum beta portfolio, are options. I wouldn't recommend you substantially allocating the majority of your portfolio to any particular sector. The less you invest in that sector, or if you can spread out the allocation throughout the sector slices, you'll be better off, I think, because as I previously mentioned, if that particular sector tanks or performs poorly, then your portfolio as a whole won't get impacted as much. Alright guys, let me know if you have any questions. You can post them down in the comments or you can message me. And as always, thanks for watching.